Okay, good morning, everyone. I hope that everyone can hear me, and welcome to this webinar on COVID-19 legal issues for Texas employers. Some people are going to continue to filter in, I'm sure, and please note that we have muted all attendees for this webinar, and because of the high volume of questions and registrants that we've already received, we're going to handle all questions via email correspondence, so I hope everyone is taking notice of the email address that we're going to be using for that. It should be posted up on the screen share right now. We will also repeat this during the course of the webinar to remind people where and how to submit their questions, because I know many of you already have questions. We're also asking that all attendees please discontinue the use of your video for this call, as it eats up some bandwidth in the Zoom platform, and video is not going to be necessary for this webinar, so go ahead and kill that if you haven't already. Thank you very much. This webinar was limited to the first 100 seats, so if you made it in this morning, congratulations, you're part of the cool club. There were actually over 150 registrations for the meeting, so of course we're going to be recording it for everyone, and as soon as the webinar is over, pretty soon after the webinar is over, everyone that registered is going to get the audio recordings of the webinar, whether you were able to make it into the meeting or not. So we'll be sending that out shortly after the meeting. So first, we're going to get started. I want to thank everybody who's attending this morning. If your email is anything like mine, I know that you're receiving dozens of invitations to join calls and webinars over COVID-19, and it's impossible to attend them all. I do think that all of the information that's being shared in these types of webinars and forums is extremely important and valuable. So we appreciate all of you guys joining us for this one that we're hosting today. Also, I think it's extremely valuable for us to operate as sort of a big think tank together as a community and as an industry, where we can all come together like this to share information and collaborate together throughout this issue. Things are moving very rapidly, as you all know, and the information that we present today, it may be outdated by the end of next week. So take that with a grain of salt, but we are staying on top of things. And so if new information comes out, we're going to have ways to disseminate that information as well. The focus of today's webinar is going to be primarily on the Families First Coronavirus Response Act, or what is known as the FFCRA. And how it's impacting companies and their health plans. We're also going to talk about what you need to be focused on as employers in regards to this law, as well as the CARES Act and the economic stimulus package that just passed, and how that relates to each of your businesses. Then towards the end, we're going to discuss how these new laws and regulations are affecting health insurance plans, both fully insured plans and self-insured plans, and what you as an employer need to be considering and focusing on in that regard. My name is Josh Butler. I'm the president of Butler Benefits and Consulting in Amarillo. We are a healthcare consulting and brokerage firm focused primarily on risk and human capital management. A little bit later, I'm going to be talking a little bit about how these new laws and regulations affect your health insurance plans. We've been getting quite a bit of calls about that right there, and I'm going to touch on that towards the end. But first, it's my distinct pleasure to introduce you all to our main speaker this morning, Vicki Wilmarth. Vicki is Amarillo's premier employment lawyer for businesses. She helps companies of all sizes in the Texas Panhandle make compassionate and strategic decisions about the many challenges employers face, not just this coronavirus. She practices law with Chris Wright and Wade Byrd in the firm of Wright, Wilmarth, Byrd, PLLC, and she has been practicing law for more than 25 years. Vicki, thank you so much for co-hosting this webinar with us today and agreeing to come on here and share your expertise with our clients, as well as so many other businesses that are represented on the call this morning. So with that, I'm going to turn it over to Vicki, and she's going to get us started. Just a second, Vicki. Let us unmute you. There you go, Vicki. Now you've got it.
Okay. Good morning, everybody. Thank you so much to Josh and Allie Butler, my friends at Butler Benefits, for letting me join them in this webinar. They are much more technologically savvy than I am, and so It has been a pleasure to work with them and to set this thing up. It seems like a millennium ago, but it was just 6 days ago that Congress passed the CARES Stimulus Act. And it was just March 18th when President Trump signed the FFCRA, the Families First Coronavirus Response Act. So a lot of stuff has happened in 2 weeks. And we have some guidance on the Families First Coronavirus Response Act, the FFCRA. We don't have a whole lot of guidance yet, official guidance on the CARES Act. So as Josh said, take everything I'm telling you with a grain of salt, because normally we lawyers have regulations and other information that we can look at to guide you through and help you make decisions. I have been practicing law for 33 years as of this month. And so I am drawing on that expertise, but some of this is definitely new territory. So we will give you the very best information that we have and my best opinions on things to answer your questions. But, you know, your individual situation may be completely different. And so I do urge you, after this webinar is over, if you have questions that are specific to your business, feel free to call me. My number is posted here. You'll get a copy of it in the slides. You can email me. I do try to respond to email within about 24 hours. You know, a lot of grace and mercy because things are crazy right now, but I will try to help you with whatever issues you have if you would like to utilize my legal services. Okay, so normally we don't have to make the kind of decisions that employers are having to make now. But Megan, if you'll go to the employers' decisions slide, here's what we're mainly focused on right now is employers are having to say, am I going to lay off my employees or am I going to try to keep my employees? Am I going to have to shut down my business or am I going to be able to keep the business going? And we're going to try to give you the information that you need to make those kinds of decisions. And there is help on both of those accounts. So if you decide you have to lay off or furlough or fire, it doesn't really matter what you call it. If your employees are no longer going to be able to work, then there are some good unemployment benefits that we'll talk about. And there's also some emergency loans from the SBA that can help you pay some expenses. If you're going to keep your employees, then I urge you to keep them at the same levels and at the same pay, because that benefits you in getting this Paycheck Protection Program loan that we'll talk a lot more about under the CARES Act. And also that way you're not violating other employment laws that you are going to have to still follow because you've got employees. And then you're going to have to figure out how to deal with the FFCRA. You know, you're going to have to give some emergency paid leave under certain circumstances, and we'll talk about when that's going to happen. Okay, so let's go and talk about unemployment assistance. So let's assume you are going to have to lay off some of your employees or all of your employees or yourself, basically. I have friends that are hairdressers that are sole proprietors, and they've essentially had to lay themselves off until these shelter-in-place orders are lifted. So what kind of assistance is available for your employees or even yourself through the unemployment assistance part of the CARES Act? There is an extremely nice benefit there, and I would urge you, if you think you're going to have to lay people off, go ahead and do it, because the sooner you do it between now and July 31st, the more money your employees can get in unemployment to help them get through this crazy time. And I've heard talk that, you know, employees are going to be able to make more money on unemployment than they are working. And that is very true in the panhandle of Texas, where we don't necessarily have people making huge salaries. So if somebody is making $30,000 a year, yeah, for the next 4 months, they will make more to be on unemployment. You know, and that may entice some people to actually leave employment. And that's just a consequence of where we are. It's not an ideal policy, but we need to help people out through these next few months. So you can see the details on the slide on your screen. You've got 4 months that employees are going to get their state unemployment benefit that they would normally get, plus $600 more a week paid by the federal government. There is a way to go on and online and look at a calculator. You put in 4 quarters worth of income, and it will calculate what your state unemployment benefit will be. It'll be somewhere between $69 and $521, okay? So you'll calculate what that is, and then you will add another $600 a week onto that coming from the feds. Now, state unemployment benefits are income taxable, and I'm assuming that the full amount will be taxable. So there will be some hit to that. But there's a couple of things that are completely different. If you're used to dealing with the unemployment system as an employer, and you usually fight the benefits and all that kind of stuff, you don't need to fight these claims if they are related to COVID-19, because there's a disaster declaration out there that the governor signed, and that overrides the chargeback provisions that usually affect employers. So as an employer, you're normally going to get a chargeback, which means that you either have to pay that chargeback off dollar for dollar if somebody claimed unemployment on you, or what most people do is they let you pay it back through your income, through your state unemployment taxes for the next 3 years. So they are waiving all that. So your employees are going to get unemployment, and you are not going to get a chargeback for that. And I've already seen it happen. We've already had a couple of those come through. Also, your employees normally would have a 7-day waiting period. That has been waived, and they don't have to search for work during the 4 months that this is in effect, because there just won't be that many jobs out there for anybody to get when you've got 3.3 million unemployment claims last week. Okay, and the other thing you need to know about this is if you are a sole proprietor or somebody like my hairdresser that does not normally pay unemployment taxes, which does happen, they don't treat themselves as employees, they don't pay a salary, and they don't pay unemployment taxes, you can still claim this. That's a very big change, is even if you didn't pay your unemployment taxes, you can still claim this. So it's very frustrating. It's very hard to get in on the Texas Workforce Commission unemployment hotline right now to get your thing filed, or even to do it online. The advice I've seen is if you need to make an unemployment claim, do it between 1 in the morning and 6 in the morning. Okay, let's move on to these emergency injury disaster loans. This is another feature that if you are having trouble keeping employees and you cannot do that, then you can get a loan directly through the Small Business Administration. These loans have been there forever. These are the loans that you get after you're hit by Hurricane Harvey and stuff, but they've changed some things about them. A lot of things, and they've made them very attractive. Sole proprietors, independent contractors, that kind of stuff, again, are available to get one of these loans, as are nonprofits. And it's a very, very good terms. You can see the terms there on the screen. There is an extra benefit that they've added here, and that is when you apply for one of these loans, you will automatically get $10,000 in emergency grant cash advance. And that's going to be forgiven. You don't have to pay it back. If it's spent on paid leave, maintaining payroll, increased costs due to supply chain disruption, mortgage or lease payments, or here's the broad one, repaying other obligations that cannot be met due to revenue loss. So if you're seeing even a small loss, $10,000 in your business, or you're expecting to see that in the next few months, then you can apply for one of these loans. You can get this $10,000 emergency grant cash advance, and you don't have to repay it. And even if you're subsequently denied this emergency injury disaster loan, you keep the $10,000. And it is forgiven as long as you spend it on basically business expenses. Now, you're going to ask about the Paycheck Protection Program, which is an amazing loan program. We'll talk about it in a minute. This emergency injury disaster loan is not mutually exclusive from the Paycheck Protection Program, but they have to be used for different costs. So, you may want to wait, for example, on this emergency injury disaster loan until you've used up your Paycheck Protection Program monies, which are going to have to be used basically in the next 8 weeks after you get them. So definitely take the PPP loan first. It's going to be wholly forgiven. These emergency injury disaster loans, you have to pay back except for that first $10,000 that you're getting. So there's a lot more to that. For example, people are wondering what the SBA is going to use to decide your credit worthiness on these EIDL loans. Do you have to provide collateral or guarantee? The answer to all of that is they're just going to look at your credit report, and you don't have to provide like real estate or something for collateral, and up to, I think it's $200,000, you don't have to provide a personal guarantee. So particularly if you're a small business or a sole proprietor, you've just got a couple of employees, or even if you're bigger. I mean, I recommend that you do these loans even if you're bigger, but for the smaller people who are more hesitant to take out these kinds of loans, because SBA has been difficult to deal with in the past, they have removed a lot of the barriers to getting this kind of emergency injury disaster loan. Okay, so those are the two main things you need to think about if you're not going to be able to keep your employees or keep yourself. For example, if you're a gig worker, if you drive for Uber or something, the unemployment and these emergency injury disaster loans are your friends. Okay, let's talk about those employers who are keeping their employees on. They need to look at this Families First Coronavirus Response Act, the FFCRA, and they need to know that, if you're one of these employers that's keeping employees, you're going to be responsible for emergency paid sick leave and family and medical leave. Both of those things are now paid leave things. And there's some things that apply to both of those. So we'll talk about what they have in common first. So you have to have less than 500 employees. You can do it if you're a nonprofit. Government employers are having to do this paid leave. And self-employed business owners can take the same tax credit if you pay yourself during this time. So part of this emergency paid sick leave and family medical leave, paid family medical leave, involves you get 100% of it back through tax credits. So it really is not supposed to be costing you anything. So self-employed, if you were to get sick, or if you have to be home taking care of your school-aged children or a family member during this time, and you're not able to work like you normally would, you can pay yourself sick leave essentially out of any, cash reserves that you've got, and you're going to get 100% of that back through a tax credit. These leaves started yesterday. The paid leave provisions started yesterday, and they go through the end of the year. And it's very much based on how many employees do you have. So you have less than 500 employees. We're looking at names on the payroll for that, okay? From the date that the leave is started. Those of you who are familiar with FMLA know that we have, all kinds of things about how do you count up to 50, or do we count integrated employers? Do we count joint employers? There's a lot of legal issues on how you count employees on all this. So just know, for the purposes of this, we're not looking at how many employees did you have for 20 weeks in the last full year and this calendar year, which is the FMLA rule. We're just saying how many names were on the payroll on the day that somebody requested leave. The other things that these emergency paid leave and FMLA have in common is employees have to take these as full day absences unless you as the employer agree to do intermittent leave. For anybody who deals with FMLA all the time, intermittent leave is a real pain. They're not making you do the intermittent leave requirements unless you want to. And some employers have already talked to me about they do want to do that. For example, if you have a employee who is home with the kids and they can only work a couple hours a day, you can put them on this intermittent FMLA paid leave, and you can just pay them for a few hours a day that they're working. Also, you know, we've talked about the tax credit. Everybody needs to put up this poster. Everybody that's on this call, unless you're, you know, self-employed and sitting in your own home, you need to put the poster up, and the link will be in these slides. And you can easily access that poster that you need to put up in your workplace. And then the other thing that both of these acts have in common is you cannot retaliate against your employees for asserting their rights to take these leave days. And I'm already seeing instances in where employers are denying this paid leave, and those are going to get reported to the Department of Labor, where they'll be investigated. There will be consequences to that, which you don't want, because the Department of Labor is tough to deal with. So you can't discharge your employees. You can't discipline them if they decide to use this leave. Okay, so let's talk about the reasons that somebody can take emergency paid sick leave. These are very, very important, and they're very, very important to know the numbers. You've got numbers 1 through 6. These are 1 through 3 are paid at one rate, 4 through 6 are paid at a different rate. My best advice to you is, when you're recording all this in your payroll records to be able to claim the tax credit, you should just refer to them by these numbers. Everybody's going to know what EPSLA reason 1, 2, and 3 are versus reasons 4, 5, and 6. And one of the questions that's coming up all the time is, in number 1, the employee is subject to government quarantine. Are these shelter-in-place laws government quarantine? No. The answer to that is no. We have some guidance from the Department of Labor on that. So basically, if somebody is sheltering in place and they can telework for you, then they're not on emergency paid sick leave. They're still working, and you pay them for the work that they do. If somebody is sheltering in place because they've been quarantined by the government, and I don't exactly know what that's going to look like, but if they cannot work and you have no work for them because your business has been shut down in one of these shelter-in-place orders, that is also not, the employee is subject to government quarantine. Basically, the only time this emergency paid sick leave works is when the person has actually been unable to work, but everybody else is working because and it's basically number 2, they've been advised by a healthcare provider to self-quarantine. They've been exposed and they're now being quarantined. Then they can claim this paid leave. It's a little crazy. We're going to have a little bit of trouble administering all of that, but just know that if you've still got work for people to be doing, you don't have to pay them this sick leave. You pay them for the work that they're doing. But then if your employee gets actually sick, or their family member gets actually sick, or number 5, if they're home for the kids and they can't work, then you're going to have to do this emergency paid sick leave. And how do you pay that EPSLA? On the next slide, you'll see that if you've got full-time people, you're paying them for 2 weeks, which is a maximum of 80 hours. There's no overtime in this calculation. You don't have to pay overtime. But if somebody worked 50 hours in 1 week, is normally their schedule, and their normal schedule is 30 hours the next week, for those of you who have, a 5-day and a 4-day schedule or something, then you would pay them whatever that normally looks like, 50 hours 1 week, 30 hours the next week, up to a maximum of 80 hours. And you don't have to pay overtime, because they're not actually working these hours, and overtime is hours actually worked. For part-time people, you got to look back 6 months and figure out what the average number of hours is that they've been working per week, and then give them that amount off in emergency paid sick leave. The rates you'll see for reasons 1, 2, and 3, it's the higher of what they normally make, including commissions, tips, piece rates, or whatever, or minimum wage. Now, how can that possibly, why do we need that? Because everybody makes minimum wage, right? No. this is referring to the restaurants that pay a lower wage and then make it up in tip credits. So basically, for restaurants that are giving this emergency paid sick leave, they have to do it at $7.25 an hour in Texas. And then if the employee's regular rate of pay is higher than that, they pay the higher one. But all of that, for reasons 1, 2, and 3, is capped at $511 per day and $5,110 total per employee. And then for reasons 4, 5, and 6, we're talking about 2/3 of the higher of the employee's regular rate of pay, capped at $200 a day, and a total of $200 total per employee. The main thing I'm seeing from all this is you're just going to have to keep really, really careful records of why somebody is out for this emergency paid sick leave, because you are going to have to be able to show which rate you were paying at, which reason they were out for, and what kind of tax credit can you get back for it. Okay, so let's talk about the other one, the Family and Medical Leave Act paid leave reasons. This is interesting. It had more in it and then got cut when the bill actually was passed. So basically, these people can claim 2 weeks of unpaid leave and then 10 weeks of paid leave. And the only people that can claim this emergency FMLA paid leave is somebody who is home with a child that's out of school or the daycares are closed. That's it. That's the only one that gets the 10 weeks of paid leave here. And why did they do 2 weeks of unpaid and 10 weeks of paid? It's because they could get the emergency paid sick leave for the first 2 weeks, and then there's 10 more weeks of paid leave after that. And then the big thing with FMLA, which has always been there, is that as an employer, you have to restore the employee to the same job or an equivalent job once the FMLA leave is over. So it's a Job Protection Act. If you've got less than 25 employees, you're going to have a little bit of leeway on that. If you had to eliminate a job position and you're going to try to make reasonable efforts to restore that employee, if you can't do that because the way that COVID-19 has changed your business, then you just have to try to get that employee back, look at them for any opening that you have for 1 year after they come back. And for those who are used to dealing with FMLA, regular unpaid FMLA rules apply under, all the other normal FMLA qualifying reasons. So if you've got an employee who is sick themselves or caring for a sick family member, and you have more than 50 employees, that employee has worked for you for 12 months, as much as 1,250 hours, and then that employee can still get normal FMLA, which is unpaid. In other words, you got to let them take the time off, but you don't have to pay them for it. Okay, let's look at the requirements on this FMLA paid leave requirements. As I said, you're not paying for the first 10 days of it, and that's effective April 1. Once the 11th day hits that they've missed up to 12 weeks, then you are paying those. And remember, we are still, just like we did under emergency paid sick leave, this is paid at 2/3 of the employee's normal rate, $200 a day, and then of course $10,000 total per employee, because we're looking at 10 weeks of pay there. And again, under this act, the leave has to be taken in full day increments unless the employer agrees to intermittent leave. And some employers are going to find that that's beneficial for them to do that. Other people who have dealt with FMLA for a long time may decide that they don't want to try to calculate intermittent leave. And an interesting thing that came out in the FAQs that the Department of Labor released is that if an employee's already used some FMLA this year, then this is not 12 new weeks of FMLA. They've already used up part of this. You don't have to go back and retroactively pay them or anything like that. It's just a proportional reduction in how much they're going to be able to, how much leave they're going to be able to take. There is an exception to both this emergency paid sick leave and the FMLA paid leave for healthcare and first responders. And there's a very broad definition on the next slide of what a healthcare or first responder is. I had a question just a couple of days ago about whether home healthcare providers are included, and they are specifically named as healthcare and therefore do not have to provide this emergency paid sick leave or this emergency paid FMLA leave. And that doesn't mean, I mean, a healthcare provider is definitely going to wind up with employees getting sick, but I think the bigger concern was letting people off for 12 weeks if the kids are out of school. Healthcare employers don't have to go along with that. Okay, let's look at other things. If you're going to keep your employees on, you need to look at other employment laws too, not just FFCRA and CARES Act. You still have to think about OSHA. Every employer has a general duty to provide a safe workplace. So as an employer, you need to really be up to speed on the CDC guidelines for what is safe. For example, I had a question recently about 2 employees riding in a pickup truck together. Well, that's not social distancing. And so you need to be looking at these CDC guidelines for your individual situation and make sure that you are providing your employees with a safe workplace to the extent of the information that is publicly available, like through the CDC. You know, you're not going to be Nostradamus. You're not going to know something that we don't all know yet. But knowing what we do have, you need to make sure that your workplace is sanitized, that people are following the social isolation rules, et cetera. You're trying to let people telework from home as much as possible and still accomplish your business if it's essential. You're also going to have to continue to comply with the ADA. But the difference is we've always been very cautious under the Americans with Disabilities Act about asking medical questions about an employee's symptoms. You can ask some very simple questions about symptoms now. You can also take employees' temperatures. Don't do it invasively. Don't, use a forehead thermometer is the best way to go if you can find one on the market. And just remember, you've got to be very sanitary with that too. You're going to have a manager who's walking up to that employee and putting a thermometer on their forehead from maybe 12 inches away. So there's going to need to be some gloving and some masking. Those are going to need to be changed in between each person. The thermometer is going to need to be sanitized between each person. So you can't just, do one employee after the other in 30 seconds before a shift starts. It's going to be more complicated than that. And remember also that anything like a person's temperature or a person's symptoms is medically private information. If it's recorded, it needs to be locked up and protected, and it can't be shared with the other employees. You can't go running through, the store that's still open at Walmart, let's say, and tell everybody so-and-so's got 100.4 temperature. We think they've got the coronas. That's confidential medical information, and as an employer, you're going to have to protect that. And finally, let me make a statement about Title VII. We have seen some very discriminatory statements that target Asian Americans based on the fact that that COVID-19 was first found in China. As an employer, you have to prevent that kind of discrimination, that kind of harassing talk about someone's ethnicity in your workplace, regardless of what politicians are saying. Title VII still says, as an employer, you've got that responsibility. Okay, let's move on quickly to what a lot of people are concerned about, and that is, I'm a very small employer. I have less than 50 employees. Do I really have to do these leaves? Or do I really have to let my employees miss work? So here is the definition from the Department of Labor of what jeopardizing the vitality of the business means. Those are the words that are in the Act. Employers with fewer than 50 employees don't have to allow this paid leave if it would jeopardize the vitality of the business. These are very difficult tests to meet. You don't have to send anything into the Department of Labor. There's no exemption that you have to file for or anything. You would just not pay the leave. Your employees would go down and complain to the Department of Labor, and then you would have to prove, as an employer, your burden of proof would be to show that these three things here, or one of these three things applies. One of the examples that we were talking about recently was the feedlots. Feedlots often have less than 50 employees. If they let people off and the cattle don't get fed, the cattle die. And so that could be that if they were giving people these leaves, for example, to stay home with the kids because the schools are closed, that might result that the feedlot doesn't have sufficient workers who are able, willing, and qualified to perform the jobs that have to be done in order to keep like the cattle alive. So it's not an easy test. Don't just assume because you have less than 50 employees that you don't have to pay these leaves. These are the kind of questions that you need to consider carefully with your accountant, with your employment lawyer, to determine whether you can meet this kind of extreme test. Okay, let's talk about the part everybody really wants to talk about. The good part is the Paycheck Protection Program loans. These are part of the CARES Act, and everybody wants to take them out, and we understand why, because it is an amazing forgivable loan. So you have to be under 500 employees, or things, there's a carve out for things like restaurants, that if they had a lot of different locations and none of the particular locations had 500 employees, then they could also take these Paycheck Protection Program loans. And even nonprofits can take them. I urge nonprofits to take them. Self-employed people can take these, sole proprietors can take these, gig workers like Uber drivers can take these loans out. Even churches, if they are registered as a 501c3, they would qualify for this. The whole point of this program is keeping your people employed and at the same pay rates during the next couple of months that are going to be rocky. So it doesn't take much of a statement. The uncertainty of the current economic conditions makes the loan request necessary to support our ongoing operations. It doesn't mean that your revenue is going to zero or anything like that. It means that you are not able to make plans. You're seeing a reduction in your revenue, whatever it is. The uncertainty is supporting your application for this Paycheck Protection Program loan. So it's up to $10 million loan. You're not going to get that much at 4% for 10 years. You don't have to give a personal guarantee. You don't have to provide collateral. You are not having to make payments for a year. But here's how they calculate it. You need to call your bank immediately. These are filling up really fast. Congress, I think, put $349 billion in this fund. We're going to go through it fast. So get your application in with your banker as soon as possible. Any bank that does SBA lending can do this. So I know Happy's already doing it. Amarillo National's doing it. First Bank Southwest. I'm sure there's plenty of others. But you just take whatever your payroll costs, including salaries, commissions, and if you're a sole proprietor, what your basic income is, that whatever you pay yourself and your employees, up to $100,000 per employee. So you cannot claim, if you've got a commercial banker that's making $175,000 a year, you can only calculate this based on $100,000 of their salary. But so you take your payroll costs, including your health insurance premiums, your retirement benefits, and your state and local taxes, not your FICA, not your mandatory payroll withholding. But you take that number, you put times 2.5, and that's how much you can borrow. Okay? And that number comes from the 1 year period that before you applied for the loan. So for most of us, we're looking at the last 3 quarters of 2019 and the first quarter of 2020. And that's how much you can borrow. Okay, then we need to talk about the loan forgiveness, because this is what we're all very interested in. So you take out that loan, you get the money. They said they're going to start trying to fund some of those loans tomorrow. We'll see. I think they're going to be totally overwhelmed. But let's say you get the funding. The way Amarillo National is doing it, I know, is they're going to set up a separate business account just for the funds from this, and it's going to act basically as a line of credit. And you're going to take money out of that account for payroll costs, interest that you have to pay on mortgage obligations, rent that you're paying in the 8-week period, utilities, not including telephone and internet, and if you've got tipped employees, that additional amount that you pay to get them up to minimum wage. So you're gonna calculate, you're gonna spend the money, I guess, in that 8-week period from the time that the loan originates on these things. And if you can, and once you've spent all of that, then they're going to determine whether your loan is forgiven or not. So here's the catch that you got to understand. On the next slide, the loan forgiveness is going to be reduced if during that 8-week period that we're talking about from when the loan originates, you've let people go or your salaries have come down. And it's interesting because the Act talks about full-time equivalents. Does that mean that you can lose one person and substitute in another person making the same, working the same number of hours, and that's an FTE? You know, we hope we're going to get good explanations on all of that. But so you're going to demonstrate that you average the same number of employees during the 8 weeks that you had earlier in the year. So basically January 1 of 2020 to February 29th of 2020, or you can look at it from last spring, February 15th of 19 to June 30th of 19. So you're just doing a ratio. How many employees did I have in the past? How many do I have now? If you have 100 employees and you only have 80 employees during this 8-week period, then you're only going to get 80% of the loan forgiven. In addition, the loan forgiveness is going to come down if you cut salaries. So if any employee lost more than 25% of their income during the 8 weeks after you get the loan, then your forgiveness is also going to be reduced by that amount. So the free money part of it can be reduced if you lose people or you cut salaries during this 8 weeks. But that doesn't mean that you're still getting part of it forgiven, which is amazing. And it's still a very favorable term loan. I mean, 4%, you've got 10 years to pay it off. You don't have to make any payments for the first year. So, you know, you may not get 100% free money, but you might get a lot. So I would highly urge you to go ahead and apply for this loan. And now I want to turn this back over to Josh to talk about the health insurance implications.
Vicki, thank you so much. That was extremely informative. And as you guys can see, this stuff can get very, very complicated very, very quickly. And so it just really emphasizes the need to have a really good employment attorney. We're going to be sharing slides with everybody that is interested. I know there's a lot of information. So again, just a reminder, we set up an email address, info@butler-benefits.com for you to reach out to us and request some information that we have, including the slides that Vicki just covered. So I'm going to just jump in really quickly with the parts how these two, the FFCRA and how the CARES Act and some of these different regulations and pieces of legislation are affecting health plans, whether you are self-funded or you are fully insured. So I'm going to just start with the first thing that everybody needs to know is that the FFCRA, the federal law, now requires that all health plans cover FDA-approved diagnostic testing and related expense with no cost sharing for the employee. So what that means is if someone goes in for FDA-approved diagnostic testing, they can't be charged a deductible, they can't be charged a copay or any co-insurance or any out-of-pocket. And so all plans, whether they're fully insured or self-funded or level funded, have to abide by this rule. Also, part of this provision is that they're waiving prior authorization or other medical management requirements for testing. So if you are fully insured, the carriers like Blue Cross Blue Shield or First Care or United Healthcare, they're doing a lot of this work in the background. But just keep in mind that the FFCRA is only mandating no cost sharing for the testing of COVID-19. And I keep emphasizing the word testing because currently there's no requirements in place that where plans are required to cover the treatment of COVID-19 without cost sharing. So that may change in the coming weeks. We don't know yet, but as the regulations sit today, plans are responsible to waive member out-of-pockets and cost sharing for testing and not treatment. Another question that came up that's popping up with us are on grandfathered plans. There's certain plans that were implemented back in 2010 that companies still have in place today. I know that they're fewer and fewer than they used to be, but there are still some of our clients and some companies that have grandfathered status. And so I want to touch on that really quickly. The new federal mandate does require that even these grandfathered plans cover all testing, COVID-related testing. And so what we're hearing is that the addition of this benefit is not jeopardizing the grandfathered status of your plan, but where we're keeping a very close watch on and a very close eye, and we're looking for direction, is if these mandated benefits are only temporary. They're scheduled to sunset right now as of December the 31st, 2020. So the question becomes, if we add this benefit and then we take the benefit away, that will jeopardize grandfathered status of plans. So we're monitoring this very closely. And if you are in a grandfathered plan and you want to keep in contact with us about the status of these temporary benefits through FFCRA, then we're happy to answer those questions. Probably the most common question we're getting is how these plans related to no cost sharing are impacting high deductible health plans. As many of you know, high deductible health plans have to follow what's called the first dollar rule, where the plan cannot cover anything until the deductible's met. Well, this is a little bit more clear, and we can definitively answer this question because the IRS has already issued guidance on COVID-19 testing for HDHPs, and they have already said that HDHPs may waive the deductible without jeopardizing the eligibility of a high deductible health plan. Okay, so many of the providers are also getting up to speed with people with high deductible health plans that are commonly associated with health savings accounts or HSAs. This new rule does not jeopardize the eligibility for a person to contribute or to utilize HSA funds. There's not going to be any penalty. But one thing that I want to clarify here is that the IRS is not deeming COVID-19 testing as preventative or a preventive measure, so it's not being classified under 213D. So that's a distinction that is pretty important. This is just an exception that the IRS is waiving the first dollar rule for all high deductible health plans. So you should not be affected there, okay? So if I'm gonna just briefly speak here in a minute about self-funded plans, but I wanna share this resource right here. If your plan is fully insured, many of these rule changes are already taking place at the plan level. The carriers like Blue Cross Blue Shield or Aetna or Cigna, whoever you're with, if you're on a fully insured plan, they're all reacting to this regulation a little bit differently. So I want to share this website with you right here, which is AHIP. It's America's Health Insurance Plans. They've done a really nice job. We're posting the link into the chat section for everybody where you can follow this. This is pretty much, it's not 100% of all the insurance carriers in America, but here you can see the Blue Cross Blue Shield of New Mexico, Oklahoma, and here's Texas. If your plan is fully insured, every plan is reacting a little bit differently to the requirements and the way they're adjusting their plans. So this is a great resource. If your plan's fully insured, we encourage you to come to this website and take a look at how each specific health insurance carrier is treating these laws and these regulations and how they're amending their plans. Keep in mind, these are temporary changes to the plan as well. Now, if your plan is self-funded, things can get quite a bit more complicated very, very quickly. And I could literally probably spend 2 or 3 hours discussing self-funded health plans, but since we don't have that kind of time, I'm going to just share some of the more important points that self-funded employers need to be focusing on right now. The first thing is, don't just rely on your ASO carrier. So if you're self-funded, but you're still utilizing a major carrier like Blue Cross Blue Shield, or even if you're using an independent DPA, don't just take it for granted and rely that they are making these changes for you. You are still the plan fiduciary, and the ultimate responsibility, if you're self-funded, is going to fall on you as the fiduciary, the plan fiduciary, and the plan sponsor to make sure that you're in compliance with these federal regulations. So the first thing that I'm going to point out is that because of these law changes, it could have a tremendous impact on your health plan. And so, because it's going to have an impact on your health plan, it may require your plan to be amended. Okay, so because of FFCRA, we are currently recommending to self-funded employers that they go ahead and use a plan amendment and add language to their plan documents that's going to keep them in compliance with the COVID-19 testing mandate. Okay, and we also are recommending that you just clearly outline the applicable cost sharing requirements under FFCRA. So for testing, that means $0 for the employee. So you may need a plan amendment change there. That same regulation also has allowed the use of telemedicine for all plans with 0 cost sharing requirements. So if your self-funded health plan is not utilizing telemedicine currently, then you need to have provisions put into the plan document where it would allow for that. So that is another key thing there. Another key provision is to evaluate the continuation of coverage provision in your plan document. Many companies that are reducing hours, maybe they've already reduced employee hours, or they're laying people off, or they're furloughing employees like Vicki was talking about a little bit earlier. Each of these are treated a little bit differently in a self-funded arrangement, and the new laws may have affected this provision of your plan document language. So we're recommending that you take a really close look at the continuation of coverage. The next one there is to make sure your plan document clearly defines actively at work. Again, if you're reducing hours or you're laying people off, they may not be meeting the definition in your current plan document language of actively at work. Some employers are choosing to waive the actively at work provision of their plan docs. If you choose to do that, we highly recommend that you be very careful. You need to be speaking with an attorney like Vicki. You need to be talking to your stop loss partners, because that's going to affect the way future claims are going to be covered and things of that nature. And then lastly, and this is very important as well, is any amendments that you make on your plans, just make sure that you may be needing to amend both your plan document and your current employee manuals or your employee handbooks. You don't need to create a contradiction there. So just make sure that if you are amending your plans, which we are recommending that you do, that you're also keeping up with the amendments in your employee manuals and your handbooks. Okay. So this is an example that we are using for some of our self-funded clients. It's an example of a plan document amendment to cover the COVID-19 testing. We're willing to share this with anybody that needs it. This has got the language in there for diagnostic testing, for telehealth services, for early prescription refills. All of these things are required provisions of the FFCRA, and we're happy to share this. You can white label it, you can put it on your logo, you can share it with your TPAs, but this is an example of a plan document amendment that's pretty easy to get integrated into your plan document. The other big consideration if you're self-funded is your stop loss. Okay, different carriers, everybody that's self-funded, you have your own stop loss partners, and I can tell you that different carriers are reacting differently. Some are requiring immediate amendments to the plan documents. Some are being a little bit rigid, but for the most part, the stop loss carriers are being very lenient, in our opinion, with these plan document amendments. They understand that this is an emergency, that it's unprecedented times, but ultimately they're going to want to see a plan amendment. The key thing is just to make sure that any plan amendment, just like in any other circumstance, if you're amending your plan, you need to be discussing those plan amendments with your stop loss, with your reinsurance carriers, because it can have a difference if you have a spec breach or if you have a claim that hits your stop loss. They have to abide and sign off on the plan document just like you do as the employer. And if those amendments aren't in place, we just don't want there to be any type of situation in the future where your stop loss partner comes back and says, well, we're not responsible for that claim. We're not going to pay that claim because it's not in the plan document. So last thing is just don't assume that your carriers are going to cover anything. You just need to communicate and ask really, really good questions. So I'm going to stop right here because we're coming up on our time. So if you guys have any additional questions about effects of how these laws and new regulations affect your particular health plans, we're happy to answer those questions. And lastly, go ahead and unmute Kath or Vicki as well right here if she, in case she wants to chime in. But guys, we have put together a whole lot of forms and templates, especially this request for emergency sick leave. I really think that that's going to be extremely critical for all businesses as your employees. If they get sick, we've been getting a lot of specific questions about, well, an employee came to us and they presented with some symptoms and the doctor told them to stay home. If you're going to be pursuing these business loans, you're going to have documentation of why you let employees off work. So the request for emergency sick leave template we can send it to you, as well as these presentation slides, the latest FAQs from the Labor Department, all of these types of things. Just shoot us an email and we're happy to share these resources. And Vicki, do you have anything else to add at this time?
Oh, absolutely. Can we take the slide share off and so I can see people or they can see me maybe?
Absolutely.
We've seen a lot of slides on this thing and I just wanted you to see a human face. Just wanted to thank everybody, of course, for attending the webinar. I hope you learned some important things. There's just an awful lot of questions that we still, just here, I'm starting the video, sorry. Now mine's disabled, so I guess I can't see everybody. But I just, there's so much here, guys. It's flying at us so fast. As somebody pointed out during the chat, and I appreciate it, the regs from the Department of Labor hit yesterday, and they're extensive. We still need to read through all those. And so I think that's why some of this general information, there I am. Some of this general information is, it's good. And I want you to kind of have an understanding of the outline of how all this works, but your situation is going to be different from everybody else's. And, I think we really need to spend time, digging into your situation if you've got some difficult questions so that we can actually match up a regulation to your situation, or we can match up, the paid sick leave reasons or whatever they are. So it's just not going to be an easy time. And like I said, I hope y'all will extend us some grace and mercy and we will do the same to you. But we just want you to stay healthy. We want you to stay well. We want you to try to keep your employees employed if you can. We want you to continue to get revenue if you can. If the revenue is going down, please explore these governmental loan options because we want that money coming into our community and stimulating our economy here so that Amarillo and the Texas Panhandle can recover quickly from all of this. So anyway, thanks so much for letting us talk to you for an hour.
Vicki, thank you again. Everybody stay safe and have a blessed weekend.